Hi, my name is Jeff Thompson, and today I'm going to be talking to you about the Alphinity Global Equity Fund, of which I'm one of the lead portfolio managers. The first slide really just, to set the scene. What you're looking at is the US ISM Manufacturing Index in green, and alongside that you've got the MSCI World Earnings Revision Ratio. So that's not actually earnings themselves, but it's expectations for future earnings. And you can see there a very clear pattern in the last sort of 2-3 years, a very dramatic COVID sell-off, historically outsized relative to anything we've seen in the last sort of 20 or 30 years, and an equally explosive recovery as we came out of COVID and as the world and central banks and governments stimulated and the world opened up again. The biggest takeaway I think from the slide though is that you've actually seen that that impulse, that earnings recovery, that economic activity recovery peak sometime in the mid last year, and subsequently to that it's moderating quite significantly. And in actual fact, in the last couple of months, I think with the uncertainty around inflation, the Omicron wave, and more recently the invasion by Russia of the Ukraine, uncertainty has really spiked, and you could probably say that the downside risks have increased. Certainly a relatively more challenging outlook for equities. We believe that the Alphinity investment process is very well positioned to continue performing through this environment. And as I'll describe in a moment, really because we invest in earnings leadership and are somewhat style agnostic, we feel very set up regardless of how this actually plays out in the next year or two, that we can still produce very good opportunities for investors. So moving forward, just introducing Alphinity Investment Management. We're an equity boutique, started in 2010. We have about $18 billion in funds under management across both global and domestic funds in 4 distinct equity strategies. We're also underpinned by or backed up by Challenger. There's 4 sort of somewhat distinct things that make us a little bit different from many of our peers. The first is the track record. We do have a very successful track record across all of those funds since 2010. We have a very experienced team in the global side. We have average experience of close to sort of 20 years in terms of the 5 portfolio managers. We also have a very flat structure. We don't have that sort of typical hierarchical structure where you have 1 or 2 very high profile portfolio managers with a whole pyramid of analysts underneath them. We have a very flat and co-PM structure. We also have very strong alignment. We all co-invest in the funds, but also very incentivized in terms of the performance of the business, but also the performance of the funds themselves. So very strong alignment with underlying investors. And finally, we have an investment process, which is somewhat of a religion at Alphinity, and I'll describe in a little bit more detail coming up, but it's really around investing in what we call earnings leadership. And what that means is that the process is very style agnostic. The process can and has proven to work across very different market regimes. So value, growth, bull, bear markets. We are somewhat agnostic as to what is the preferred environment. We can perform across all of those. So just moving forward, that slide presents the global team. So 5 portfolio managers. We have dedicated ESG and sustainability resources, dedicated quantitative analyst, as well as a dedicated trader. And as I mentioned earlier, we have the support of Challenger stroke Verdante, with over 160 staff that help us in the back office, but also with distribution and marketing. So moving on to the investment process itself at Alphinity, really there are 2 fundamental investment beliefs to have. The first is that earnings surprise drive share prices, and the second is that these earnings surprises are serially correlated. I think we'd all agree that a surprise in earnings, that's fairly intuitive, that generally speaking is well received by the market and generally associated with strong stock performance. And secondly, these surprises are serially correlated. So when you do get one surprise, you typically get 2, 3, 4 coming after that. There's a quote by Warren Buffett, which he has so many good ones, but it goes along the lines of where you meet a cockroach in a kitchen. Generally speaking, you tend to meet his family over the course of the next few days and weeks. And what he's referring to is, generally speaking, when you get a profit warning from a company, a negative surprise from a company, typically that is followed by 2, 3, 4 other negative surprises. And what Alphinity is trying to do is invest in the opposite of that. We are trying to identify companies that are in a positive earnings upgrade cycle, where there's an underlying positive product launch or a launch into a new business, something fundamentally that's changing and improving the company that's manifesting in these positive surprises. So this chart really, just to describe what you're looking at, the bottom line is the MSCI World going back to 1988. It's given you 6% per annum CAGR. The black line above that is really with no foresight at all. You're simply investing in companies that have already experienced the top quintile, the best earnings revisions to the market over the last 3 months. That alone gives you a 3% uplift in performance, which is interesting. But really, I think the opportunity set is if you can identify with good fundamental research, if you can identify companies 1 month in advance that are going to be receiving positive earnings surprises, you can see there with that top blue line, you're rewarded with quite abnormal outperformance. So obviously we're not promising that, but it does, I hope, explain to you why if we do what we say we do, if we do that well, there's going to be an enormous tailwind in terms of performance. So you're going one step further, we then try and invest in that earnings leadership when it's backed up by high quality, so strong businesses with strong cash flows, high and rising margins, good returns on equity, strong management structures and good industry structures, because those earnings cycles we think are more consistent, they're more reliable and more dependable when backed up by quality. And then finally, obviously, you don't want to overpay for that. So there's a very strong value discipline in everything we do at Alphinity to making sure that we're not overpaying for these earnings upgrade cycles. So it's really those three things we're looking to do: earnings leadership, high quality, and valuation. On the right-hand side in the slide, you can see what we call the earnings life cycle clock. And really what it tries to do is describe a typical cycle in a company's earnings, where 6 o'clock is that point of maximum pessimism, typically after a long period of negative surprises, where sentiment around the stock is very negative. And then from that point in time, it starts to surprise positively and goes through this positive cycle where it peaks out at 12 o'clock, with the reverse, where there's point of maximum optimism. What we try and do, obviously in a perfect world, you'd invest at 6 o'clock and sell at 12 o'clock. In practice, it's almost impossible to do that. So what at Alphinity we try and do is invest at that sort of 7 a.m. moment after you've actually had the first positive surprise. And what that does is avoid the value trap, which is so painful for performance and really increases the hit ratio in the process. And then using our value discipline primarily, we seek to sell out of the stock before it hits that 12 o'clock moment, before proverbially when we're on the dance floor, the music stops and everyone's running for the exit. That can be very, very painful for performance. So typically we're trying to exit at 10, 11 a.m. on that clock. Really trying to bring that to life in terms of two stock examples. I've included one value cyclical stock that's in the fund at the moment, and also sort of one sort of more structural growth stock. And you can see both are fully within process. And you can see that the process really is very comfortable investing in both value and so-called growth stocks. So Bank of America, the United States leading consumer bank, are really leaning into digital, but also sort of very geared not only to higher economic growth, but also very geared to high interest rates. And you can see there on the left-hand side, the blue line being earnings expectations. The black line is the share price, and the shaded blue areas where we've owned it. And you can see, again, that earnings upgrade cycle that we're looking to invest in. And on the flip side, on Prologis, the world's leading industrial logistics player, enjoying very, very strong tailwinds from the restructuring of supply chains around e-commerce and translating to very strong rent increases. And again, you can see the blue line being that earnings upgrade cycle, and you can see how the share price and performance has actually followed suit. Taking that to a portfolio level, this slide shows you the Alphinity Global portfolio since inception in 2015. The red line is the earnings expectations for the MSCI World, so in other words, for the market more broadly, for every calendar year through that time period. And you can see that generally speaking, most of the time, analysts enter the year quite optimistic and then generally have to downgrade expectations. The blue line is the outcome for the Alphinity Global Equity Fund over that time period, and you can see that every year we've managed to identify and invest in a portfolio of high quality businesses which are seeing superior earnings outcomes. And it's really, this is the tailwind that drives performance in the strategy. And more than that, you can see that this has actually occurred through very, very different distinct time market regimes through that. We've had strong periods of strong cyclical recovery, we've had periods of slowing global growth, and in all times we've been able to invest in good quality companies that are seeing better earnings upgrades. Slide 9 is the top 10 of the fund. You can see quite concentrated at a stock level, the top 10 being just less than 50% of the fund, but very diversified again from a sector perspective. So there's 3 tech stocks in that top 10, there are 3 healthcare stocks, 3 consumer stocks, as well as a bank, but all high quality and all seeing superior earnings outcomes. Slide 10 gives you a sense of the geographic and sector diversification of the portfolio. So you can see we invested across most sectors and also most of our exposures through multinational companies with very wide and diverse underlying geographic exposure. And finally, slide 11 just gives you a sense of the performance of the strategy since inception in 2015, which has been positive, but I think more pleasing from our perspective is, I guess, just the consistency of that performance through very different parts of the cycle and different types of market. And again, very, very typical of what we would expect from an Alphinity strategy. So just finishing off, the last slide just gives you some contact details if you did want to reach out to Fidante for more information about the fund. But thank you very much for your time.